Bismillahirrahmanirrahim. In the previous class, we discussed about international Fisher effect. Today, we are going to start another chapter. Chapter name is Foreign Direct Investment. You people know about foreign direct investment, equity invested in foreign country with intention to have control. We discussed about this in international business that if this is one country, this is another country, and a person or a company from this country, he is going to invest money in this country, and they are purchasing shares more than 50%. You can say 51%, at least 51%. To have control, significant control, or you can say management control, we call this investment foreign direct investment. If it is less than 51%, then we call it portfolio investment. Sorry. But if it is more than 51%, then it will be called FDI, foreign direct investment. FDI. So equity invested in foreign country with intention to have control. What is the intention? The intention is to have control. An investment made by a company or entity based in one country, it belongs to one country, into a company or entity based in another country, and the company is investing money in another company which is based in another country. Just like here, I told you about this, that one company or one person, he is investing money from this country to this country. Suppose this is Afghanistan and this is USA. So from Afghanistan, a person is going to USA and he is investing money in this country. So we call it what? We call it foreign direct investment. Entities making direct investment typically have significant degree of influence and control over the company into which the investment is made. Significant control means more than 51% shares, either by setting up a subsidiary or associate company in foreign country, by acquiring shares of an overseas company, or through a merger or joint venture. This is possible. This foreign direct investment is possible if this company is making a subsidiary company, a new subsidiary company in this country, or they are making a joint venture in this country with another company. Suppose this is company, this is your company, and you are making a joint venture, or you are acquisition, you are acquiring this company. A company from this country is acquiring this company. So this is also the possibility. Purchase of land, or purchasing land, building, equipment, and inventories to set up company abroad, or purchasing land, then making a building, then purchasing equipment and inventory to set up a totally new company abroad. So there are possibilities of this, that it can be a joint venture, it can be purchase of shares in foreign country more than 50%, it can be through acquisition, or it can be through purchasing, making a totally new company by purchasing land, by purchasing building, and by purchasing machinery and all other things. Here are some examples. An American company taking a majority stake in a company in China. Any American company, he is purchasing majority stakes in China. So it will be an example of FDI. Canadian company set up a joint venture to develop a mineral deposit in Chile. There is a Canadian company and they are making a joint venture with a Chilean company to develop mineral deposit. So these are the examples of foreign direct investment. Why does company invest abroad? Why companies are investing money in foreign countries? Seeking new customers. They want to find new customers for their products. So this is the first reason that companies invest money in foreign countries to find new customers for their product. High profit margin abroad. Maybe in your country competition is high, competition is intense competition. There are lots of companies here in your competition, so your profit margin, it will be low if competition is high. If competition is high, your profit margin will be low. So if profit margin is low, so you want to find another market for you in which the profit margin is high. So this is another reason for investing money in foreign countries, high profit margin abroad. To achieve economies of scale, economies of scale means if you produce goods in bulk, in big quantity, your cost of production, it will come down. So there is another possibility that in foreign country, you want to invest money because you want to produce more, and when you want to you will produce more, your cost of production, it will come down. So this is another reason for investing money in foreign country. Access to new sources of material and technology. Some companies, they are investing money in foreign country because they want to find new sources of raw material and new sources of technology in foreign countries. Just a minute. So they want to find new sources of raw material at low cost and technology. They want to find new technology in that country. Like majority of companies, they are producing they start their production in China because of cheap raw material and cheap labor cost and good technology. To diversify its products and markets, they want to diversify their products and their markets. So these are the reasons for investing money in the foreign country. Now, key factors of FDI. What are the key factors in foreign direct investment? What increase in incremental demand for products of the company will result from the foreign investment? Now, this is the first point. If you are investing in foreign country, so what will be the increase in incremental demand for the product of the company? Will there be increase in demand for the products of company or not? This is a question that you are asking from yourself. If we will invest money in foreign country, what will be the increase in demand? What will be the incremental demand for the products of the company? If it will increase the demand of the product of company, okay, go there and invest money. But if there is no demand, no increase in incremental demand, don't invest money in foreign country. Keep in mind, whenever you are going to start a business, so first of all, you're looking for the demand, whether there is demand of that product in that area or not. So here we are investing money in foreign country, so we will look at the demand, increase in demand in that foreign country or not. If there will be increase in demand, too much increase in demand, then you will invest money. But if there is no increase in demand, you will not invest? So that is a question that you are asking from yourself. At what price in terms of foreign currency can the goods or services be sold in foreign country? If you are investing money in USA, so at what price you will offer the product? $1, $2, or if you are investing in Dubai, so at what price you will offer the product in the foreign market? So at what price in term of foreign currency can the goods or services be sold in the foreign market? So at what price you will sell or your products will be sold in the foreign market? What are the fixed and variable cost of production in foreign market at various level of output? There are various levels of output. Like if you are starting business on small scale, on medium scale, or on large scale. If it will be on small scale, what will be your fixed cost? What will be your variable cost? If it is on medium scale, so what will be your fixed cost? What will be your variable cost? If it is on large scale, so what will be your fixed cost and what will be your variable cost? You will estimate this thing. That if I will start my production in that country on various levels, so what will be my fixed cost and what will be my variable cost? This is an important question that you will ask from yourself when you will invest money in the foreign country. So here, what are the fixed and variable cost of production in the foreign market at various levels of output? What is the full cost of investment? What will be your first full cost? How much of the cost can be recovered if the project fails? Now this is a question. If the project fails, how much cost can we recover? What is your full cost of investment? And if the project fails, how much cost will be recovered if the project fails? What proportion of the investment can be brought in the foreign country and what proportion of investment will be brought in the country and how much needs to be imported and how much money will be imported? Imported from where? From where you will import? What grants and tax concessions can be negotiated with the government in foreign country? And when we are investing in foreign countries, so we will negotiate with the government of that country that will they give us some tax concessions and some grants if we invest money in their country. So the government, which terms can be negotiated with the government in the foreign country? What is the working capital requirement for the foreign project? How much money will we need for running the day-to-day operations? What amount of working capital will we need in that foreign country? Will these requirements are very different from the requirement in the home country? You will ask a question from yourself. Will there be any change in the requirement in the home country and in the foreign country? For example, higher level of inventory be maintained to service production because of increase in distance from supplier. You will produce products here and you will send these products here to sell. So the distance is too much. So you will keep high level of inventory here in this country. Why? The distance is too much. So too much distance, so you will keep high level of inventory. So maybe you need more working capital for this. Investment in inventory, it needs a huge amount of working capital. So you need more stores, you need more godowns, and different other things. So this is a question that you will ask from yourself. What is the expected rate of inflation in the foreign country? What is the expected rate of inflation? Because in inflation, it is affecting the prices. How disruptive high rate of inflation would be to the production. And if inflation rate is high, it will affect your production and sales in foreign country. It will affect the production and sales in foreign country. How would the predicted rate of inflation impact on exchange rate between the home and foreign country? And just like we studied in international fishery effect, that this increase in inflation rate will affect the exchange rate. So here, how would the predicted rate of inflation impact on exchange rate between the home and foreign country? So these are the questions that you are asking from yourself before investing in foreign country. What is the cost of funds in foreign country? If you will take loan in foreign country, or if you will issue shares in foreign country, what will be the cost of funds? What will be the cost of financing? What proportion of these funds can raise locally? And what portion should be imported from abroad? So can these funds, what proportion of these funds can be acquired locally, means from local banks in foreign country? And what proportion should be imported from the abroad? And what will be the proportion that will be imported from abroad? How has the cost of funds moved in recent years in foreign country? And what about the cost of funds in foreign country? Is there increase in cost of funds? Cost of funds means cost of equity, and cost of debt. In equity, then we have preferred stock, we have common stock, and in debt, bank loans, bonds, and different other. Okay, is this investment project likely to be permanent project or capital venture with fixed life? You're asking a question from yourself. Is it a permanent project in foreign country, or it is a venture capital? Venture capital means for 2 years or 3 years fixed project, and after that you will finish the project and will come back. So is it a venture capital or is it a permanent project? If lifetime is short, what is likely the terminal value of the project? If it is a venture capital, so what is the terminal value? What is the value? How much money can we recover? Can we get from this project? What are the exchange control regulations in the country? Is there any exchange rate control regulations in the country? What are the rules regarding repatriation of profits from the country? And when you invest money in that country, you will earn profit and you will send this profit back to your home country. So what are the rules regarding sending back of profit from the foreign country to the home country? Are these rules applied rigorously? So strictly that country is applying these rules or not? So what are the exchange control regulations in the country? Are they controlling the exchange rate or not? What are the rules regarding repatriation of profits from that country? When we earn profit, how we will send these profits back to our home country? Are these rules applied rigorously? That country is applying these rules strictly or not? How stable is the exchange rate between home country and foreign country? Exchange rate is stable between these two countries or not? Are devices such as swap, forward, and future contracts are available in the country in order to hedge exchange rate exposure? So different devices like swap, like forward, and future contracts, these are available in that country to you can say to hedge exchange rate exposure. Hedging means to control, to what we people say, to control the risk of exchange rate. These are tools used for controlling the exchange rate risk. So are these devices available in that foreign country or not? Like swap, like forward, and future contracts. How stable is the government of that country? The most important question. The government is stable or not? If the government is not stable, don't invest money in that country. In which investment is to be made? What is the political risk index? The political risk index in that country, what is it? What is the political risk index attached to the country by political risk assessors? Different international companies, they are publishing political risk index for different countries. Sorry. So what is the political risk index? This country is stable country, or this country there it is politically risky? What tax rules and regulations are imposed on the profits made by the company in the foreign country? What are the tax rules and regulations imposed in that foreign country? Are any subsidiaries available to encourage foreign investment? Are there already some foreign subsidiaries available or not? Or you are the first to start the foreign direct investment? So these are the questions that you will ask from yourself when you will invest money in the foreign country. Is foreign investment riskier than home investment? On its traditional view, foreign investment is riskier because managers are familiar with local conditions, while it is difficult for them to get information regarding many factors which were discussed in introductory lectures. So this is your assignment. Yes, foreign investment is riskier. Why? Because of the cultural differences, because of the new environment, because of the religion, because of different other factors. So what will you do? You will write an assignment. This is your assignment. Foreign investment is riskier. Why? Why is foreign investment riskier? So in this class, we discussed about foreign direct investment, that what is foreign direct investment. Then we discussed about examples of foreign direct investment. Then we discussed why does company invests abroad? Why we are investing money in foreign country? So we discussed that we want to find new customers, we want high profit margin abroad, we want to get economies of scale, we want to access to new sources of material and technology, and we want to diversify the product and markets. Then we discussed about the key factors of foreign direct investment. The key factors, we discussed that when we will invest money in foreign countries, so what will be the incremental demand? What will be the increase in demand? Then we discussed that at what price can we sell the product in foreign country in terms of their currency. If we are investing in USA, so we will sell our product in dollars. If we invest money in Saudi, so there will be Saudi Riyal. We will sell our product in Saudi Riyal. So what will be the price? At what price can we sell this product in foreign country? What are the fixed and variable cost of production? What is the fixed cost of production? What is the variable cost of production at various levels of output? Various levels of output means small scale production, medium scale production, and large scale production. If small scale production, so fixed cost will be low, variable cost will be low. If medium scale production, so fixed cost will be medium, variable cost will be medium. If large scale production, so you need a huge sum of fixed cost and variable cost. What is the full cost of investment? What will be the total cost on this investment? How much of the cost can be recovered if the project fails? So how much cost can we recover? What proportion of the investment can be brought in the foreign country? How much investment can we get in that country, and how much money we will import? Then we discuss that what will be the working capital requirement in the foreign country. Will this working capital requirement different from the requirement in the home country? We need more money for working capital in the foreign country, or it will be just like the same in home country. If you are sending products from home country to foreign country, then you need high level of inventory. So you need more working capital. So these are the questions that you are asking from yourself when you are investing money in foreign country. What is the expected rate of inflation? What will be the expected rate of inflation, and will this inflation affect our demand, our sales, our cost of production or not? What is the cost of funds in foreign country? What is the cost of debt? What is the cost of equity? So what is the total cost of financing in that country? How much money we can raise locally and how much money will be imported? So these are the questions. How much money can we raise locally and how much money will be imported from foreign country? Is this investment project likely to be permanent? Is it a permanent project, or it is just a venture capital? Permanent project means its lifetime is what? Is high. And venture capital means it is for 3, 4, 5 or 10 years and then you will finish it. What are the exchange control regulations in that country? What are the exchange control regulations? These exchange control regulations are applied strictly or not? Then the next is, how stable is the exchange rate between these two countries? And if it is not stable, the exchange rate is not stable, so there are tools, devices for controlling the exchange rate risk, that is swap, forward and future. So these tools are available or not for controlling the exchange rate risk? The tools, the devices like swap, forward, future, options, these are available or not? How stable is the government? The government is stable or not? If the government is not stable, don't invest in that country. So how stable is the government of the country in which investment is to be made? What is the political risk index, and what is the political risk index in that country? What tax rules and regulations are imposed on the profits made by the company in the foreign country? When profit is made, so what are the tax regulations for foreigners? What will be the percentage? What percentage will be deducted as tax in the foreign country? The more important things. Companies are making investment in those countries in which the tax rate, it is low. Are any subsidiaries available to encourage foreign investment in the foreign country? There are already foreign subsidiaries available or not to motivate the foreigners to invest money? So these are the questions that you will ask from yourself when you are investing money in foreign country. So now the traditional view is, yes, foreign investment is riskier than home investment. You will find different reasons for this, and you will write an assignment on this. That is foreign investment riskier than home investment or not? Inshallah, in the next class, then we will start a new chapter, and maybe that will be our last class. Have a good time. Assalamu alaikum.